Nvidia is up 100% in 1 year. During this time frame, the S&P 500 went up 24%. Its competitors that also increased are Broadcom, up 86%, Marvell, up 70%, ARM Holdings, up 27%, and AMD was the only one to decline, down 30%. Since the last Q3 earnings release on November 20th, Nvidia's stock has gone down about 5%, so not a huge change. Ahead of Nvidia's FY25 Q4 earnings release next week on February 26th, let's review Nvidia's current state, its recent significant developments, and what to expect going forward. During the Q3 earnings call in November, management guidance for Q4 revenue was between $36.75 billion and $38.25 billion. The analyst consensus estimate predicts that Q4 revenue will be slightly higher than management guidance at around $38.67 billion. Analysts have a reason to be optimistic because in the last 6 years, the revenue surprise was positive in 22 out of 23 quarters, meaning Nvidia's actual revenue was higher than the analyst consensus estimate 96% of the time, except for 1 quarter in April 2022. If the upcoming quarter also shows a positive revenue surprise, then Q4 revenue represents growth of over 70% year over year. And adding the past 3 quarters' actual revenue, the FY25 revenue represents over 110% growth year over year. Earnings per share consensus estimate for Q4 is 0.843, which is 63% growth year over year. And the FY25 EPS sum is 2.946, which represents 128% growth year over year. Nvidia's EPS has been growing every quarter for the last 2 years. Actual earnings per share have also beaten analyst consensus estimate most of the quarters in the last 6 years as well. Similar to the revenue surprise trend, EPS surprise was positive for 21 out of the last 23 quarters. Another important metric to look at is how the market reacted to the earnings announcements. Take a look at this 7-day price reaction for every earnings release for the last 6 years. The first row is the 7-day price reaction. Green is when there was a price increase, red is when there was a price decline, and gray is when it was almost flat. The next 4 rows show the revenue, EPS, EBITDA, and free cash flow surprises, and the last 4 rows show the year-over-year growth for revenue, EPS, EBITDA, and free cash flow. What does this tell us? Simplifying the analyses, price reactions showed moderate sensitivity to analyst surprise metrics. EPS surprise and revenue surprise have the strongest relationship with stock price reaction, while free cash flow surprise does not show much correlation. And interestingly, stock price movement is not highly dependent on year-over-year growth metrics. What has affected Nvidia's stock price movement more than the earnings metrics are macroeconomic factors, such as global supply chain issues, the company-specific events, including competitive pressures and shifts in consumer demand. In the upcoming Q4 earnings call, management will provide guidance for FY26 Q1, the duration of which is between February 1st and April 30th. Their guidance will have an impact on the share price since it will signal any macroeconomic factors and the forward-looking state of the supply and demand of the AI chips. Analysts believe that management guidance for Q1 won't be as rosy as their performance in the last quarter. The revenue and margins may be impacted because of 3 key concerns, which are supply constraints of Blackwell chips, reduced demand of Hopper chips, and the ongoing restrictions in China. But let's take a look at each one in more detail. After Nvidia rolled out transitioning their data center chips from Hopper to Blackwell in October 2024, there were design flaws, overheating issues, and rising production costs. This led to a slight dip in gross margins. Nvidia's CFO Colette Kress did confirm during the Q3 earnings call that Nvidia will not be able to meet the demand due to supply constraints and that this will take a few quarters for them to resolve. However, in January, Nvidia CEO Jensen Huang said that the supply constraint was due to packaging from TSMC and they need more advanced packaging as the kind of technology is changing. But he still assured us that TSMC's packaging now is able to supply 4 times more than it did 2 years ago. And Nvidia won't be cutting orders from TSMC. Instead, they will take every order that TSMC is able to fabricate. Another concern that analysts expressed ahead of the Q4 earnings call next week is the possible decline in Hopper chip demand. Although Blackwell is their newest GPU that uses 4% of the energy compared to Hopper, Hopper's demand is still strong. Here are two recent announcements from last week that may indicate that demand is not an issue for Nvidia. Last week, on February 11th, the stock climbed up further upon announcement at the AI Action Summit in Paris that the European Commission would invest 200 billion euros on AI infrastructure, and France also announced spending 100 billion euros in private investments into AI infrastructure. This includes 20 billion euros to build special AI factories, each needing 100,000 advanced AI chips. This may translate into over $12 billion. Nvidia may not be the default supplier, as the European Commission is striving to enhance its technology sovereignty so that they don't rely overseas. Competitors with stronger European presence, such as AMD, Intel, ARM Holdings, and Halo Technologies, present alternative options for AI chips. The European Commission is also actively investigating Nvidia's business practices over potential anti-competitive behavior in the AI chip industry. But to date, Nvidia's technology remains ahead of its competitors, particularly in high-performance AI processing, which means while the EU may seek to diversify its reliance on AI chips in the future, its immediate need to close the gap with the US and China in AI capabilities may point to orders from Nvidia in the next year. On February 17th, South Korea announced it will secure 10,000 high-performance GPUs within the year to bolster its national AI computing capabilities. While specific models and suppliers have not been finalized, Nvidia's H100 and H200 processors are strong contenders due to their leading performance in AI applications. This might add another $500 million for Nvidia if Nvidia becomes the sole supplier. The South Korean government aims to finalize decisions regarding GPU models and partnerships by September 2025. Demand does not seem to be an issue in the near-term outlook, but is the company fairly valued, or will the market correct the valuation premium? The trailing PE ratio is 47 times. The 1-year forward PE is 32 times, and the 2-year forward PE is 25 times. 1-year forward PE drops significantly because of the estimated growth in the earnings over the next year. Relative to its historical data, the forward PE ratio is not high. From 2017 to 2023, before the AI chip boom, Nvidia's average forward PE ratio has been 58 times. And from 2017 to today, including the AI chip boom, Nvidia's forward PE ratio has been an average of 68 times. With this perspective, Nvidia's forward PE ratio today of 32 times is relatively not overvalued. Compared to its peers, Nvidia is trading higher than the average on a forward PE basis, but Intel and Marvell are trading higher than Nvidia, and Broadcom is valued at a similar PE level. Nvidia's cash and liquid securities position as of the Q3 earnings statement was $38.5 billion, and their debt is $10.2 billion. Their net debt to EBITDA ratio is negative since they have more cash than debt. Nvidia's free cash flow yield is 1.9% and estimated to grow year over year with higher free cash flow generation. Their metrics tell us Nvidia has strong liquidity with flexibility for strategic investments, R&D, and potential acquisitions. They have minimal leverage risks and a robust cash generation going forward. Last week, Nvidia sent a signal to the market about one of its long-term strategies. The company reduced its stake in ARM Holdings by approximately 44% and exited investments in Serve Robotics and SoundHound AI. Meanwhile, Nvidia acquired 1.7 million shares in China's self-driving startup WeRide, a company that utilizes Nvidia's advanced processors and AI software for autonomous vehicles. While Nvidia has not publicly detailed the specific reasons for these divestments, industry analysts suggest that the company is concentrating its resources on sectors where it sees the most significant growth opportunities. The autonomous vehicle market is projected to expand substantially in the coming years, making it a strategic focus for Nvidia. Only 2% of Nvidia's FY24 revenue came from automotive, which presents a big growth opportunity for Nvidia to partner with and increase their revenue from the autonomous vehicle market. Nvidia plans to unveil new technology, the GB300 and Rubin chips, at their upcoming GTC conference on March 17th, which could act as a catalyst. They plan to show how the chips will expand into robotics and quantum computing. Analysts continue to be optimistic about Nvidia. Out of 62 analysts, the median target price is $175. And as of December 31st's filing, 16 of the top 20 shareholders increased their position of Nvidia, indicating more favorable outlook in Nvidia compared to its competitors. We look forward to Nvidia's earnings announcement on February 26th and share more insights when it comes out.